We've been talking a little bit about some of the price activity this morning. We've been primarily focused on the Fed's rate decision yesterday and the market's reaction to the news. That's yesterday's Fed news that they left rates unchanged. They lowered guidance and announced some changes to the balance sheet. Stocks and stock index futures products rallied on the news with treasuries as rates came off, which is about what you'd expect to see, again, considering the current global economic and market conditions that we're in. But I think it's important to remember that with the markets becoming increasingly 24-hour and more interrelated than ever before in terms of dynamic correlations and inverse correlations, it's important to drill down to the source of where the energy is generating from. And that's why we've asked our next guest, Alan Nuckman, the chief market strategist at Agora Financial, to join us this morning, because if there's one guy I know who's willing to roll up his sleeves and get right into the thick of it, it's this guy, Mr. Alan Nuckman. Good morning to you and welcome back to the show. Alan,
Ben.
Good morning. Yesterday we had a special 1-hour edition of Midday Movers here on the network. We really highlighted the Fed, the rate decision, and the market's reaction too. I got to say, every guest we had on the show for the most part said the Fed was making the right decision. You know, for me, whenever anyone agrees on something, one thing, market related, I take cover. Is the Fed on the right track with this one, Alan?
Yeah, I'm actually a little bit more cautious. It's interesting that I've been on the side that the Fed was doing the right thing all along over these last 10 years, getting us the market results that we wanted. But I'm starting to question a little bit this psychology shift, this total 180-degree turn, which I don't think is as warranted. But, you know, we're here for price action. We're here for market movement. But there was nothing new to see here with the announcement yesterday. We all knew there are not going to be any rate hikes in 2019. And looking further out, looking at 2020, looking at the Eurodollar futures contracts as your indicator, there's a possibility of a rate cut in 2020. So that's what the markets are telling us. The markets have been right. The rest of this stuff, I think, is getting to be a little bit too much noise. And it's interesting that people had complained over the last years about the Fed's action, and now they're notably silent. So it's interesting to see traders' reaction. But let's just focus on what we have right now. We have a bull market in stocks and a bull market in treasuries.
Yeah, let's talk a little bit about some of that price activity. Alan, does the sudden shift in the sentiment, I mean, you mentioned that it does somewhat concern you, but we've gone from a situation where we were talking about possibly 3 rate hikes in 2019 to none.
Right.
I mean, certainly it's concerning to the bond bears, I would say.
Well, what's interesting to me is the fact that all those rate hikes were predicated on the idea that, you know, we've got that much strength in the economy. And that, I was looking at that as a positive sign.
Too.
It's like getting an A on your report card. When the Fed says we have so much strength that we can continue to raise rates. Let's remember where we are in this cycle and how historically we're still super low rates, that if we can't raise rates in this economic environment, the question is when.
Yeah, when
if we
we'll
can't
be able
unwind
to.
our balance sheet now, the question is when. And I'm the most optimistic trader you're ever going to meet. So this gives me something to pay attention to. Now, I'm not calling for a break, B-R-E-A-K. I'm calling for a little bit of a break, B-R-A-K-E, a little pause maybe in this enthusiasm as people kind of rattle this around in their heads. What does this really mean? But I think it raises more questions in people's minds than anything else. The Fed has to have a certain level of, like I do, confidence. That confidence is very telling, and this shows to me a lack of confidence, and they're kind of mealy-mouthed, wishy-washy, and really to turn their sentiments that much in the last year. Where were we a year ago? Completely opposite.
I'll tell
completely
you,
opposite where we are now.
I'll tell you where we were a year ago, Alan. We were on the show here talking about how the shorter end of the yield curve was leading to the upside. Now we're watching the shorter end of the yield curve, which is actually leading to the downside. I've got a chart up here for our viewers to take a look at of the 5-year relative to the 30-year. For the most part, the 30-year has been hanging out sideways right around this 3% level. But if you take a look at the 5-year, it just got down to 2.30.
Yeah, and this flattening is unprecedented.
Yeah.
But like I've said before, I don't think it's as significant because rates are so low. If rates were normalized and we were at 4.5% short-term rates, then we could talk about some of these relationships.
Right.
But I don't know if you've done any surfing, but we call this mushy. Mushy, 1 to 2. We've got the 10-year and the Fed funds target like 1 to 2 ticks apart. It's amazing. The 10-year is down here at the same price as short-term interest rates. So that's just something that I don't think I remember seeing here recently, and it's certainly got my attention. Now, this doesn't mean that the stock market and markets can't continue to go higher. I'm still looking for continued asset reflation. This just means rates are low. We should see, as rates go down, the stock market continue to move higher. Just from a money flow standpoint, where's the choice? Why are people not going to be going into stocks if they're getting these kind of yields? There's still no choice, and it's gotten worse instead of better as the economy has bounded back.
Alan, talk to me. What does this mean for the U.S. dollar? I mean, we've got rates into new lows that we haven't seen. We're going back to last year. I mean, the dollar, for the most part, still holding in pretty strong. We've talked about how some of the strength in the dollar is related to weakness in foreign currencies, but ultimately, with rates into new lows, what does it mean for the dollar index?
Well, the dollar had topped out once again and had gone down for maybe 10 sessions or so. Has a little bit of a bounce here today, but yesterday it was under pressure. I think it was at multi-week, month-and-a-half lows. So at some point, but it's still we've got the euro currencies, the British pound just bottoming out, trading sideways. We got the dollar kind of up at its top, trading sideways. So we're not seeing anything significant in the currencies, and it's just a matter of time. That spring is getting more and more and more compressed, and eventually there's going to be a big blowout. I'm not saying which direction, but I'm not as concerned about the dollar. And just using common sense, which doesn't apply to trading, but using common sense, you'd think it'd be hard for the dollar to strengthen with the fact that we're not going to raise rates, in the next years.
Alan, I wish you had told me common sense didn't apply to trading years ago. That's probably what's been wrong with my P&L. I've been applying too much common sense, unfortunately. Alan, really appreciate you joining us here this morning. That's a great look at some of the price activity that we've been seeing, and a look at treasuries, a look at the dollar and rates in general. Alan Nuckman joining us from the trading floor at the CME here in Chicago. He's the chief market strategist at Agora Financial. Now, what a great segue, us talking about